What is the history of interest rates in monetary policy? Imagine a world where borrowing money costs different amounts at different times. That's what interest rates are all about, and they have shaped economies for centuries. Let's take a quick journey through how they evolved and why they matter today. Long ago, before central banks existed, interest rates were mostly driven by market forces and the gold standard. Countries pegged their currencies to gold, and interest rates helped keep currencies stable and prevent inflation. Governments and traders watched these rates closely to decide when to lend or borrow. In the late 1700s, the Bank of England was founded in 1694. It started setting interest rates to keep the currency stable and manage the money supply. These rates changed often, depending on economic needs, like controlling inflation or encouraging growth. This was the beginning of central banks using interest rates as a key tool. In the United States, the Federal Reserve was created in 1913. Its main goal was to stabilize the banking system. The Fed used interest rates to influence how much people and businesses borrowed. Lower rates made borrowing easier, boosting the economy. Higher rates slowed things down to control inflation. During World War II, the Federal Reserve kept interest rates very low to help fund the war effort. They capped yields on government bonds, which increased the money supply. After the war, inflation started to rise, and the Federal Reserve faced a challenge. The Treasury wanted low borrowing costs, but inflation was a concern. This led to the 1951 Treasury-Fed Accord, which gave the Federal Reserve independence to set interest rates without Treasury interference. In the 1950s and 1960s, the Federal Reserve used interest rates to smooth out economic ups and downs. They would raise rates during booms to prevent inflation and lower them during recessions to encourage spending. This approach was called leaning against the wind because the Fed tried to balance economic growth and inflation. The 1970s and early 1980s saw inflation skyrocket, reaching over 14%. The Federal Reserve, led by Chairman Paul Volcker, raised interest rates to nearly 20%. This caused a recession but finally brought inflation under control. It showed how powerful interest rates are in managing prices. Since then, the Federal Open Market Committee has regularly adjusted interest rates to keep inflation in check, promote employment, and support growth. Changes in interest rates influence borrowing costs for homes, cars, and business investments. They also affect how much money banks lend and how consumers spend. Overall, interest rates have been a vital part of monetary policy, helping steer economies through good times and bad. Their history shows how central banks use them to keep prices stable and support economic health over many years.